to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, this week's market wrap with commentary and analysis from Money Metals Exchange, the company named Best Overall Precious Metals Dealer by Investopedia.
Welcome to this week's Market Wrap podcast. I'm Mike Gleason. Coming up, we'll hear from our good friend David Morgan of the Morgan Report. You won't want to miss Mike Maharrey's discussion with the man they call the Silver Guru, who tells us why he believes the underlying economic issues go beyond just trade wars and tariffs, and how they are actually much deeper concerns when it comes to America's dependence on China for critical resources, among other things. David also weighs in on the tremendous rebound we've seen in gold and silver prices following the steep correction that occurred just 2 weeks ago, and what that is telling us about where the metals markets may be headed here in the near to medium term. So be sure to stick around for that and a whole lot more during another wonderful conversation with the great David Morgan coming up after this week's market update. Gold's record run has been nothing short of astounding, and it appears the bulls have plenty of strength left in them. Since the beginning of the year, the price of gold is up over 25%. That's on top of a 26.5% increase in 2024. The yellow metal is by far the best performing asset of this year. As for this week's market action, with the markets now closed due to the Good Friday holiday, gold added another $90 this week to close at $3,341 an ounce. That's a 2.8% increase on the week. Silver's gain is more muted. It checks in at $32.75, up 25 cents or 0.8% for the week. Platinum gained 2.4% and closed at $987, while palladium was the biggest winner among the precious metals. The industrial metal leapfrogged its cousin platinum to close at $992, a 4.4% advance since last Friday's close. Please note that despite the fact that markets are now closed for the week, money metals will be operating during normal business hours both today and on Saturday. According to Metals Focus, considerable fresh inflows from institutional investors have been a major factor in the latest leg of the gold bull run. We see this trend in significant flows of gold into ETFs. According to the latest data from the World Gold Council, gold-backed funds accumulated 226 tons of gold in the first quarter, the largest quarterly increase since the third quarter of 2020 at the height of the pandemic shutdowns. In fact, ETF demand has been strong across all regions, and while Western investment continued to dominate global ETFs, demand has ramped up in China and India as well. According to analysts at Metals Focus, the bull run still has plenty of momentum behind it. However, despite these rising investment inflows, investor gold allocations remain below levels seen at the height of the pandemic and well below the Great Recession. Higher gold prices have created some headwinds in the gold market, though, particularly in jewelry demand. Metals Focus analysts argue that this market tightness will eventually ease. So what is driving the gold bull market? The simple answer is the trade war and the uncertainty that comes along with it. But it's important to remember that gold started climbing long before President Donald Trump moved into the Oval Office. And there are other factors in play, including de-dollarization, geopolitical instability with military conflicts in Ukraine and the Middle East, and inflation worries. However, tariffs are currently in the spotlight. President Trump's hardline trade policies have rekindled fears of stagflation, which subsequently led to a sharp pullback in U.S. equities. Federal Reserve Chairman Jerome Powell even raised the specter of stagflation during a speech earlier this week. It's interesting to note that gold was the last safe haven standing during the stock market rout last week. Other haven assets, including bonds and the U.S. dollar, have not fared well. Monetary easing has also created tailwinds for gold. Central banks in India, New Zealand, and the Philippines all cut rates last week, and the European Central Bank delivered another cut this week. While the Federal Reserve has held rates steady, the markets have priced in 3 rate cuts this year. That assumes no major economic meltdown. If the economy crashes, as many now expect, the U.S. Central Bank will almost certainly slash rates to zero and relaunch quantitative easing, unleashing another tidal wave of inflation. Central bank gold buying has supported this gold rally from the beginning. Central banks globally have added over 1,000 tons of gold to their reserves for 3 straight years. To put that into perspective, central bank gold reserves increased by an average of just 473 tons annually between 2010 and 2021. Metals Focus said it is too early to forecast a recession, but it doesn't seem to be factoring in the bubble economy blown up by the Federal Reserve's monetary policy into its analysis. Keep that in mind. While the overall environment is extremely bullish for gold, it won't likely be a ride straight up. Well, now, without further delay, here's Money Metal's exclusive interview with the silver guru, David Morgan.
Greetings, I'm Mike Maharrey, a reporter and analyst here at Money Metals, and I'm joined here once again by my good friend David Morgan. He is the publisher of the Morgan Report and the author of the Silver Manifesto, and an all-around awesome guy and a fine analyst. How you doing, David?
Mike, I'm doing well, thank you.
Well, it's always great to have you on, and there's certainly no lack of subject matter to talk about. I kind of want to start with last week, which was obviously a really wild ride for investors. And I just want to kind of start and get your general impression and ask you, what surprised you about how things unfolded last week when we had the trade war kickoff, and then we had the stock market sell off, and then we had Trump, I guess, kind of reversing course? I'm not even sure. What kind of surprised you about this, or did anything?
I think what surprised me was that, the metals reacted negatively. That wasn't such a surprise. What the surprise was how quickly they bounced back. Mm-hmm. That was a surprise to me. Normally, when you're in these type of situations and everything gets hit and hit hard, gold sympathizes. Usually it's the only good asset when everything's going south. So fund managers primarily will sell gold because it's something in the green and cover a margin call.
Right.
But this time, gold shook it off. It went down very slightly, bounced back. A few days later, was making another new high. And silver got clobbered. I mean, silver lost like 14% within a couple of days. Mm-hmm. But it came back stronger than I expected. I go, oh boy, we're going to have to wade through more overhead resistance and on. And it's not all the way back to where gold is, but it's bounced back strongly. So that was actually a surprise, which says, because I always try to stay objective. I can't be. I'm very biased toward honest money, sound money, precious metals. But nonetheless, I try not to let my emotions guide my decisions.
Right.
And with seeing the silver market do that much, it's signaling strongly that gold and silver certainly have a long ways to go. Mm-hmm. And a little late to the interview, I apologize publicly, but I was reading John Hathaway's interview on Sprott Money, and just boggles my mind at how little gold is in the financial system when you're looking at money managers and asset allocation. And for from 2017 on, he did the study. So from 2017 to the current day inclusive, it's a very small percentage that people have even 5% gold exposure.
Yeah, I've read that too in other sources.
So that's it. That's my surprise.
Yeah, I'm kind of with you. The how fast it bounced back and how much. Like, you kind of expect it to hit a bottom and then rebound and correct back, but to see it go up and then all of a sudden talking about new highs, that kind of surprised me a little bit. So, if you're listening to the mainstream analyst, everybody's talking about tariffs. The entire focus is on tariffs. It's all about tariffs. I read today that some 60% of CEOs say they're worried about a recession because of the tariffs. So it's tariff. And, obviously this is playing out in a much broader economic environment. And I'm curious what you think people might be missing that is underlying all of this, that is not necessarily about the tariffs, because I don't think it is just tariffs. And I have a feeling you probably agree with that.
I do agree with that. I mean, if you look at some of the best thinkers on, true freedom, true independence, true sovereignty, you look at what does that consist of? Mm-hmm. And basically, you go back to the Jeffersonian era. Basically, what it meant was that you were a Renaissance man, meaning you knew, master of none skills of everything. So you were agrarian in those days, and you grew your own food, you made your own clothes. Also, you were not dependent on any outside source.
Right.
So you can notch that up into a state or a nation state and say, well, if we are all encompassing and we produce all the energy we need, all the food we need, all the clothing we need, all the housing we need, you're, from that standpoint, from a nation state standpoint, you're independent. And America has become extremely dependent on China. One couple that most people know, one is the rare earth elements.
Right.
And without the rare earth elements, you really don't have a lot of Teslas or windmills or solar panels or a lot of these things. The other one is medicine. A lot of the pharmaceuticals are produced in China. And the last one just blows my mind because it is a national security issue. And it seems, my opinion, whenever, there's a deep state problem or whatever, and we should get the information is, in the free market, it's suppressed because of national security. And in my opinion, they use that cover quite often. Well, it's a national security issue, therefore you can't get this freedom of information request.
Right.
I digress slightly to say this. We have stuff that is in our military that comes from China alone.
Sure.
Is that insane or what?
Yeah.
I mean, that is absolute insanity. So the big picture is that China depends on us to buy their goods.
Right.
And without us buying it, then China's in dire straits. So the bigger picture is, forget the tariffs, just look at trade overall. And if we're not trading, then we're lowering our standard of living worldwide.
Right.
And I've been saying that for a number of years, that the world economy is contracting, not expanding. So you have a contracting goods and services, tariffs or no tariffs, and you have an increasing money supply, which is the classic hyperinflationary startup or makeup. And this is, China's wants to keep the trade going. But there's two huge egos involved here, one out of the current administration and Xi Jinping. And Xi Jinping has basically decimated his, what we would call the cabinet in our political system, in the communist China regime, gotten rid of people that actually had experience, put in his, what we refer to in the slang as his bros, his friends and his colleagues that have no experience in warfare, logistics, international trade, diplomacy, and all this. So he's running the show with a bunch of yes men under him, which spells, in my view, a more likelihood of a disastrous decision or decisions that will impact both sides. So it is bigger than the tariffs. And not to sound like an apologist for Trump, because I'm not really that fond of the man, but the idea that the tariffs are responsible for this, and this really isn't responsible thinking, in my view, because we were going to get here anyway.
Yeah.
No doubt in my mind. I mean, I've been saying this for how many years? 20 years. It's just that this was kind of a trigger. So then that begs the question, was it deliberate or not? Was this like a setup to get this thing rolling this direction where we had to admit that America's been living beyond its means for decades by printing pieces of paper, getting goods and services from other countries, and then having them recycle that paper into the treasury market and pretend that it was savings? Jig's up.
Yeah.
I think the tariffs is more or less a trigger for it.
Yeah, I've wrote an article, I guess last week, and was just trying to point out the fact that, we've created this effectively a bubble economy that's floating around waiting for a pin. And tariffs very well may be the pin, but I've been kind of arguing that even if they're not, if they manage to negotiate around this and settle this aspect of it down, there's still a bubble and it's still waiting for a pin, and there's a pin out there somewhere.
Well, I agree. I think the tariff is the pin. And once you pop the balloon, you can't pump it back up very easily, as we both know.
It's ruined.
So whether or not these things get reduced or there's certain exemptions and, let's say they kiss and make up as a metaphor and everybody's more or less happier with the result than they are right now, will not change the dynamic. The dynamic is what I said earlier, and this is a contraction in the economy.
Yeah.
And that doesn't spell increased living lifestyles for everybody. It creates the opposite.
Right. One of the things that I thought was kind of interesting, I was looking at the VIX, the volatility index, the other day, and you can see these big spikes of volatility in recent history. There was one in 2008, obviously, and then during the pandemic, and then we just had a spike. Didn't quite reach the level of the pandemic, but it got pretty close. I think it got up into the upper 50s, and it was in the 70s during the pandemic area. I think that given the way Trump operates, his strategy, his negotiating tactics, I think we can continue to expect a lot of volatility because he just creates uncertainty. We don't, one day we're having tariffs and then we have a 90-day reprieve, and this is just kind of modus operandi. How would you suggest that an investor navigates this extreme level of volatility that we're seeing right now? And I would argue we're likely to see for the next 4 years.
Yeah, it's very difficult. One, it's quite emotional. And if you've read Are the Deal, I mean, this is my metaphor and you don't have to agree with it. But, one negotiation technique is, I'm going to negotiate something with you. So we walk up and we're within the arm's distance of each other. And the first thing I do is slap you in the face.
Yeah.
And then I back off. Say, I didn't really mean it,
Right.
But this is the methodology that Trump does, and people don't really know it or see it for what it is. It's his style, you might call it. But to answer your question, what do you do? Well, first of all, you look at the big trends, and the big trends are stocks up and gold neutral up until the last 6 months or so.
Right.
And now we've got a big shift, and I mean a big one. So you've got equities going lower, gold going up. So you've got to pay attention to the main trend. Even if you don't like gold, that's irrelevant to being an objective investor. You've got to go, the trend is your friend. The trend is asset allocation is changing. And that's kind of what this article I mentioned earlier from John Hathaway. But if you're not on board now, you're going to wish you had been. Because $3,000 gold may look cheap in 2 years. Yeah. That's one. The other one is to not keep your emotions in check and dollar cost average. You don't have to get all in and all out. Oh, I'm getting out of stocks.
Right.
Now get into gold. And then 3 months later, gold's gotten under 3,000 for whatever reason, which it could. And stocks are almost at a new high. And you just kick yourself. Mm-hmm. So you set up a plan where I'm going to lower my stock exposure by 20% a year and increase my commodities exposure by 20% a year or something like that. Do that over a couple of years or do it over a year or whatever, but you don't need to make a decision and be 100% right on the day you make that decision. You want to use your ability to work with the trends, and that means they're going to ebb and flow up and down, but let's get on board with the major trend, which is stuff we don't need and stuff we do need. That's basically a lot of stuff that, look at the car market. I mean, a lot of things. So anyway, I won't drone on. That's the idea. Stay relaxed as you can, even though the volatility, this is to me, it's an indicator of the emotional state of the market. And everyone's panicking. That's a time to stand aside, take a deep breath and evaluate.
Right. Yeah, I agree completely. It's so easy to get panicked, to knee jerk, and it's always wise to avoid that. One of the conventional wisdoms, I think, and I was hearing a lot of this, as we were kind of running up to the tariffs, and that was the notion that it would probably lead to dollar strength and treasury strength. And over the last few days, we've seen the exact opposite. We've seen extreme dollar weakness, and we've seen a big sell-off in the bond market. And in fact, really, the only safe haven that was standing at the end of the last week was gold. You had the dollar and treasuries both selling off. Does that surprise you, first off? And then second off, what do you think is kind of creating this contrarian situation that a lot of people I don't think expected?
One, it doesn't surprise me because I've expected this at some point. If you look at Exeter's pyramid, and I was one of the first to bring it up, a lot of people have forgotten about it. I'm that old, but I was at a dinner after a speakers meeting. I brought up Exeter's pyramid to one of my friends in the newsletter business, Jay Taylor, and he never heard of it, but it's made its rounds. In fact, that article by John Hathaway talks about the Exeter pyramid. So basically, if you don't trust a dollar today, why would you trust one 10 years out?
Right.
Or 30 years out? And I think the markets, it knows that, but it hasn't manifested that until this last week, really. I mean, there's been instances.
Right.
And gold is superior to everything. And that goes right along the Exeter pyramid. As the liquidity event takes place and you need to have real money or what's considered real money quickly, then things that have low value or high risk disappear and things that have guaranteed stability get bought. And that's gold and silver. So I'm not surprised. And what did it mean was your second part of the question. It means what I said a moment ago to me, and that is that the allocation shift is taking place. I said it, I think, our last interview, where the run to gold has begun. And I didn't get a lot of pushback. A lot of people, what's he talking about? He's a gold bug or whatever. And I said, look, the run to gold starts in the stealth mode, and the smart money moves in when no one wants it. And that's been the central banks the last couple of years.
Yeah.
That started the gun. That was the gun. That was the gun going off. So you don't see him because the race is way down there and you're at the finish line. You can't even see them. They're so far down there.
Right.
Now they're starting to appear. Now they're coming up and you can see them. And so, you know what? Maybe gold isn't such a bad idea. And maybe the dollar isn't going to be king of the hill forever.
Yeah. It's interesting to look at Russia. They look really smart when you look at retrospect. 10, 15 years ago, they were the biggest gold buying central bank. They started buying even preceding the buying that we've seen of late. And that has played out very well for them through the course of the war with the sanctions. And it has really created a lifeline for their economy because it is real money and it can be used anywhere, even when their dollar assets and their euro assets are frozen. And I think it's interesting just to kind of see how that played out and not justifying I'm not trying to hold Russia up as this great nation state. It's obviously got its problems, but obviously they were pretty smart in loading up on real money before getting themselves into a situation where their assets were going to be cut off.
Yeah. I'm going to say something controversial that probably will hopefully get you more views. I'm not saying I agree with it totally, but it certainly made me stop and think. And this was probably not 10 years ago, but maybe 6, 7, 8 years ago. And I give credit where credit's due. I cannot remember who made the statement, but it just did kind of set me back on my heels. The statement was that Russia's becoming the United States and the United States is becoming Russia.
Wow.
And, you think about all of the loss of freedom that we've experienced over the last decade. And, again, I'm not a big proponent of Russia. I'm not in love with Putin. But you look at their economy and it looks like he really does care for his people. Maybe that's my imagination. I've never been to Russia. I got very close when I was in Mongolia. But regardless, it just made me think, geez, here's a country that's known, communist and control and people are not free and, all these problems. And basically they've, what you might say, westernized, not U.S. westernized, but classic Western ideology from the time of the Greeks. And you look at the amount of freedom that's been taken away. So I don't want to dwell on it, but I thought it was interesting to put in that context because who would have thought, when I grew up, that would be, you could even make a statement like that.
Yeah. It's interesting. I think people of our age have a little bit different perspective than youngsters because we recognize just how different the Russia of today is from the Soviet Union that, we grew up worrying about dropping bombs on our heads.
Yeah.
I've It's for me, it's kind of weird because I always thought in the 90s, like, wow, what a shift. This is a great opportunity. We can develop a good relationship with this other power across the sea. And it unfortunately just didn't work out that way. So,
yeah, I have to say, I just want to get this in. I agree. I mean, it's like, come on. Because, there's one thing I want for everyone, it's freedom.
yeah.
Freedom, you have responsibility.
Mm-hmm.
But peace, I mean, honest to goodness, going through, my dad served in the Korean War. I missed the Vietnam War by just a few numbers. I was the last year they drafted. My number was high enough. I didn't go. But anyway, I'm just reiterating what you said, Michael.
Mm-hmm.
But honest to goodness, can't we think of all the amount of capital, just not only money, but physical labor and people involved in a war effort?
Yeah.
And what good does it do?
Yeah.
I mean, and I'll say one more thing. I was on record. I'll repeat it. All wars are bankers' wars.
Yeah.
And that is a movie, a documentary by a gentleman out of Hawaii. I forget his name at the moment, senior moment. But you can look it up. I think it's for free. It might even be on YouTube. All wars are bankers' war. He makes it worse, makes a very good case for that.
Yeah. Yeah, absolutely. I want to touch on silver real quick. We've seen the gold silver ratio. It was over 100 to 1. I think it might be just a tick below, but we're still in that 100 to 1 range, which is extremely high from a historical standpoint. But I was talking to this guy the other day, and he said to me, Mike, he said, I think this is the new normal. We're going to see this big spread, and we're not going to see it snap back as maybe we have in the past. Maybe 80 to 1 might be the new normal. How would you respond to somebody who thinks that maybe we've had this fundamental shift where we have a new normal with a much wider spread between gold and silver?
Well, first, let me say, I cannot say he's wrong. I don't know the future. I'll also say that some of the better known stalwarts in my genre, in the financial newsletter business that focus on resources and metals, one of them has kind of made the same statement. But I disagree. I think that the money metals, first of all, you look at the correlation. Gold to silver is around 85%. Now, it may not be that high lately, but it's probably still above 80. And there are very few things that are correlated that high.
Right.
So you look, well, gold does this because it's an industrial metal, then it does that because it's a monetary metal. The silver never asks if it is or isn't, whatever it is. It's just bought or sold, and it trends with gold when there's recession. It trends with gold when there's an inflation. It trends with gold most of the time. So I think that's argument number one. Argument number two, can I share my screen with you?
Yeah.
I'm going to send you a request. And this is a graph from Matt Watson, who I was introduced to by the Silver Institute. And what you can see here is the silver demand for a low case. Now, we all know that we've had a silver deficit for the last few years. Some say 4, some say 5.
Right.
It's averaged about 200 million ounces a year.
Uh-huh.
But what's important on this graph is over here at the 1 billion ounce level. That's what we mine and recycle in a year.
Right.
And you can see it kind of ups and downs. And he basically shows it going lower to the right, which makes sense, at least at this point in time, because the grades are getting lower and lower.
Right.
So there's less and less silver per ton coming to the surface. And the recycling is kind of stalled out as well. So I think that's a valid assumption for at least the 10 years, maybe not the 25 years he has on this graph. But what you see is from current day onward, we have to eat the above ground supply of silver to meet supply and demand. They have to meet somehow. And if you're not mining enough, then you got to get it from where? Well, you don't get it from thin air like the money supply.
Right. You can't print it.
You have to get it from the stockpile of silver that's held by institutions through the ETFs and individual investors such as you and I.
Right.
Well, if you go out, let's go 10 years to 2035, and you look at the number from there to there, you're looking at almost 500 million ounces of silver in that 1 year as a deficit.
Right.
Well, the above ground silver supply held by the registered category and the banks probably is no more than 2 billion ounces.
Mm-hmm.
So you're looking at maybe 2 or 3 years, and you've, in theory, eaten up all of it.
Right.
So now what do? Where's that come from? There is no above ground supply. Well, there always will be.
Sure.
But let's say the transparent above ground supply has disappeared. Okay, let's say it that way.
Mm-hmm.
So everything that's in the ETFs, everything's on the COMEX, everything's on the LBMA is gone, in theory, again. So now the rest has to come from people, the stackers,
Mm-hmm.
And we don't know how much is there. Maybe another 2 billion, maybe 3, maybe 1. We don't really know.
Right.
But what this says, and this is a conjecture, this is looking for, but it is the low case. If we look at the high case, it accelerates this curve I'm pointing at right here.
Yeah.
And there's one thing I disagree with them. So let's talk a little bit about it. All the dark green here is solar. Mm-hmm. So he's not showing a huge increase in solar. In fact, he shows it in the latter years kind of tapering off.
Yeah.
He does show automotive going up gradually. He shows other industrial basically as a steady state. I'd argue it's going to continue. It might be going up slightly, but with silver batteries and other things that silver will be used for, I think that's conservative.
Uh-huh.
Jewelry is a constant. I'll agree with that. Silverware is just this little orange constant. I agree with that. It's a very small part of the market. It's 4%. Mm-hmm. But here's where I have a big discrepancy. I want to give you the question. I'm going to flip the interview. He's looking at a steady state investment demand for silver all the way through. I say hogwash.
Yeah.
I say as the gold market accelerates and gold's too pricey for people. The word gold and silver in the Bible correlates about 85% of the time. Very seldom that gold only and then there's silver only. It's usually gold and silver. But regardless of them being tied together, I didn't think that we'll see gold get too expensive for a lot of people that wake up late and say, I got to protect my savings. I can't afford gold. My savings account will buy me 2 ounces of gold and I can buy silver. In fact, it's pretty cheap at a gold silver ratio. So my point is that this could be, the curve could come down to the left, meaning because of increased investment demand, we will see this theoretical depletion of the above ground supply actually take place sooner than projected by this curve. Again, this is a low case. In the high case, it shows that.
Yeah.
And that's it. Last thing I want to say, Mike, is on 2020, he shows the investment demand here. I don't know what that number is, 200 million ounces. Not true. In 2020, the total investment demand was 500 million ounces. 320 million ounces was in the investment category, institutions, and 200 million was us silver stackers, which is basically 200 million. So just bear that in mind, that as he shows it here, isn't really true, at least in that year, that gray bar should have been much, much higher
than that
than it was. So now the question is, knowing what I just showed you, what do you think the gold silver ratio? Is it going to be a new paradigm, or is it going to come back to something more like 70 to 1, 50 to 1, 30 to 1?
Yeah, I've been saying all along that I think that it's going to revert back to the mean. For one thing, things just tend to do that. We have averages for a reason, and I'm kind of looking at the same thing you are in terms of the investment aspect of it. I think it's definitely going to pick up for the reason that you mentioned. It's an alternative to gold as gold gets more and more expensive. And I'll give you an anecdotal story. I was just talking to a guy last week, a friend of mine, who he's like, I've never really gotten into precious metals. I've got my 401k, but I see all of this chaos, and I can't afford gold. What do you think about silver? So he was already kind of in that process, being somebody who was looking into precious metals for the first time. And I'm certain that he is probably indicative of a lot of folks out there. So, and just looking at the history of it, as you mentioned, gold and silver both are fundamentally monetary metals. And we see that correlation over time. And I don't see any reason why all of a sudden that would cease to exist. It could, as you mentioned. I don't have a crystal ball, but I'm inclined to agree with you that that this is
Well, the main problem with silver as a monetary metal is that the banks do not associate silver as monetary metal. And of course, they do gold. And they, as I said, they've been buying gold, quite a bit the last couple of years, and over time they're always buying. Well, they have, England sold all of its gold. Canada sold all of its gold. I mean, that's very foolish in my view. But the point is that silver has never been a monetary metal in the banking system for a very, very long time.
Yeah.
And if it were, and they did a 16-1 or 30-1, there's not enough silver out there to bring that ratio.
No, there's no way.
So it would have to be revalued at, something more like a 10-1 kind of a ratio or whatever.
Yeah.
And then its value is money. But right now it's so cheap, and it's kind of that way because of many reasons. Some is the way the price is derived through the derivatives market.
Right.
In others, there are no bank holdings. And the other one is that no one really pays attention to it. And that I think is deliberate because both gold and silver are really suppressed from the Wall Street perspective.
Sure.
Because everything is stocks and bonds, and no one wants to talk about precious metals.
Mm-hmm. Well, I have a feeling people are going to be talking about precious metals a lot more as we move forward into the future, just by the virtue of what's going on with the dollar. And so, yeah, definitely. Well, I'm going to let you get out on this. I want you to let folks know where they can follow your work, where they can find the Morgan Report, and how they can get your valuable insights on a regular basis.
Well, the best thing is go to the landing page, themorganreport.com, and you can sign up for our free newsletter right there on that front page. And then there's icons in the upper right. There's, of course, the membership portal, but next to that is the YouTube channel, our LinkedIn channel, our Twitter feed. And the Twitter feed's the only place I'm not shadow banned. And I post every day on Twitter. Usually, I just posted that Hathaway article I keep referring to. There's a lot of good information passed back and forth on X or Twitter, whatever you want to call it. Second thing I'd like to mention, Mike, is I think I mentioned it last time, and that's my documentary's been filmed. It's getting finalized. It's silversunrise.tv. A lot of trailers out there to look at. We have a lot of people that are pretty well known. G. Edward Griffin as one. Ellen Brown, who wrote Web of Debt, and she's for state banking over federal banking. It's a whole topic in itself. So I'll leave it at that. Those two websites, themorganreport.com and silversunrise.tv.
Excellent. Well, I really do appreciate your insight and time. You always bring a very valuable perspective, and I know folks always love when you come on. So I appreciate you being on, and I'm sure we'll get you on here, down the road as things continue to unfold. But we do appreciate very much the work you're doing, and again, thank you for your time.
My pleasure. Thank you.
Always enjoy hearing from David Morgan. Good stuff there as always. Well, that will do it for this week. Be sure to check back next Friday for our next weekly Market Wrap podcast. Don't forget to tune in as well to the Money Metals Midweek Memo, hosted by Mike Maharrey and released each Wednesday. To catch any of our weekly audio programs, just go to moneymetals.com/podcast or find that on whatever podcast platform you prefer. Until next time, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a wonderful weekend, everybody. He is risen.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes. For answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds, call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by to answer your call during business hours, Monday through Saturday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.